Welcome to the Aramir Roundtable. Today is the 14th of November, 2018. So welcome, welcome Iggy. Nice to have you.
Hello, Tom.
And before we get started, our normal disclosure that Aramir is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. We're not making any specific trade recommendations. Past performance is not indicative of future results, and hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I will stop sharing and turn it over to you, Iggy. Okay, we're back with Iggy's desktop.
Do we see it now?
I do, and I'm going to mute myself just so there's no background noises, but I'll be here and pop in if needed.
Okay, thank you. Thank you, Tom.
Sure. Yep.
Hello, everybody. My name is Igi Schalajda. I'm 58 years old, and I'm living here in Germany, in Stuttgart, Porsche town. And I want to tell something about my triple tool trade. This is a signal service which is running since the beginning of 2018. And I made some updates to it. And I added some portfolios to it. So let's start with my presentation. I tell about the triple tool trade. These are 3 volatility-based portfolios. I trade volatility on the S&P, not on Russell, not on NASDAQ, not on DAX or something like that. And that's why I have to look at the VIX index, which is the fear index. The definition of the VIX index is here, like you see it here, CBOA. It's from the CBOA. The VIX index is a calculation designed to produce a measure of constant 3-day expected volatility of the US stock market, and that's on the S&P 500. It's made out of call and put options and so on. You can read that on CBOA, so let's go on. This is the VIX index, the red one, and this is the S&P 500. And as you can see it here, every drop to the downside has a drop to the upside in the VIX because there's a fear market could drop down, and as long as there's a fear in the market, the VIX is going up. And when the S&P is going to the upside, then there will be a reverse to the mean, as you can see it here. It's always between, you have to look at on the right scale, between, let's say, 10 and 20. In this range, most of the time, the VIX is placed. So all my systems are related to the VIX, but I don't trade the VIX because you can't trade the VIX. I will explain it in 1 minute. I trade baskets based on VIX futures, short-term and mid-term. Why do I trade VIX baskets and not the VIX? Here, the conclusion is here just at the beginning. It's the built-in drift in the VXX, SVXY and SIF and so on, which makes them an outstanding underlying. One characteristic of VIX is reverse to the mean if it exploded sometimes to the upside. As you can see it here, it explodes, but it comes back to the bottom here. Always after every explosion, the explosion sometimes takes sometimes longer, maybe sometimes shorter. It came back in shorter time, but it always it comes back to the bottom. It always is reverse to the mean. So, but most of the time, you don't know when really big eruptions will occur. You know, volatility is going up before some known events like elections or Brexit or something like that. But normally big eruptions. So let's have a look at here. Here you see the Brexit, and here you see the election. Not really big eruptions. The really big eruptions were Lehman crisis. Here was a flash crash. And here the volatility crash. And these are unknown events with a huge eruption. It's much bigger than other eruptions like Brexit and elections and so on. So it's the unknown event which causes big eruptions. So there are three reasons for me why I do not trade the VIX, because I don't know when will there be an unexpected eruption and how huge will it be. Whereas the top of the eruption to profit from the way down, to profit from reverse to the mean. And finally, you can only trade futures on VIX, which have different prices on different expirations. So this is the VIX, which has a drift. And here I marked the downdrift. Here's the updrift, here's the downdrift, updrift, downdrift, updrift, downdrift, updrift, downdrift, updrift, downdrift, updrift, downdrift, and here a small updrift again. And as I saw, this is a log scale. So here you can see this is 30, and these are nearly 500,000. And it is the built-in drift from the beginning. From the beginning, the real trading started 2009. And this was hypothetical results because VIX futures started in 2004, and you can adjust this price and make the calculations back to 2004. But there was no real trading in the VXX. So the real trading in the VXX started for 2009, will last 10 years, and then there will be another VXX. It's called the VXXB at the moment, which will start in January 2019 for another 10 years. So this VIX is not finished, but it goes on. So that's why I trade VIX future baskets, and there are short-term baskets like VXX and SVXY, and midterm baskets like the TIF. Z always means it's a midterm product. Short-term basket VXX is based on futures of front and following month, like F1 and called F1 and F2, the future 1 and future 2. And the midterm basket VXZ, as you see here, the Z for midterm, is based on futures of F4 to F7, means F4, F5, F6, and F7. SVXY is simply spoken the opposite of the VXX. If SVXY is going to the upside, VXX is going down to the downside, and same for VXZ and ZIV. So this is VIX Central, a very interesting page. And here you see the futures, F1, F2, F3, F4, F5, 6, 7, and 8 sometimes. And the basket VXX is made out of these two futures. And for the explanation of the basket will be shown in 1 minute. And the short-term basket is made of these two futures, and the midterm basket is made out of these 4 futures, 4, 5, 6, and 7. And one important thing is, here is the VIX future, here's the VIX, and here's the future. You can't trade the VIX. You can only trade the future. So this is a comparison between VXX in a log scale, which is the black one, and the VIX, which is the red one. Here you see reverse to the mean, and here you see a drift. And when I saw this chart at the first time, I said, wow, what a trend. And the reason for trading the VXX is, again, it's the built-in drift. The VXX will always trend because it's built in. But of course, there are some eruptions to the upside, and these are pretty big eruptions. And as you can see it here, you are here at a level of about 4,000, and here you are at a level of about 16,000. It's 400% going to the upside. So VXX shorting is extremely risky. This is the SVXY, and here there is something in the mathematics of calculating the SVXY. It is possible that theoretically the SVXY can be negative, and that's why the ETN, the bank which makes the ETN of SVXY said that if there will be an event when the VIX is double the price in one day, they can take the SVXY out of business for a while, or complete knock it out, like the XIV, which was from the Credit Suisse. They knocked it out and made a loss of 500 millions in one day. That's fine. So this is the SVXY, which has a drift to the upside. But here there is the acceleration event. But I will not talk about the acceleration event in detail, because this can be in another seminar, but not today. And this is the TIF. This is the midterm, and as you can see it here, the drop down is much smoother than in the SVXY. But both have a trend to the upside. This is no logarithmic scale. And here it's also no logarithmic scale, but here it came down from roughly 95 down to about 60. And here it came back more than 90%. So what is the reason for trading the basket? As I said before, it's the built-in drift. So look at the chart. Basket means for VXX, this is from sixfigureinvesting.com, where you can read it. They hold a mix of VIX futures, the two leftmost ones for VXX, UVXY, and TVX. That's adjusted every day in order to keep the average time to expiration of the portfolio at 30 days. In this daily transaction, some of the leftmost next to expire futures are sold and longer dated futures are purchased. That's why there is the built-in drift, and this causes the downdrift, so-called contango loss in the VXX, and the updrift in the SVXY and ZIV. And there's a drift of, roughly speaking, 85 to 90% of the time. I don't know any other underlying which is more trending over such a long period of time and will also be trending in the future. Look for new all-time lows and highs. Look for a relationship of up and down days. Here, these are the all-time lows here, the blue line here at the bottom. These are all-time lows. And as you can see it here, when there is an eruption, there will always be new all-time lows. There's the eruption, new all-time lows, a big eruption, new all-time lows, an eruption, all-time lows, flash crash, new all-time lows, volatility crash. No all-time low at the moment. There's still the all-time low in January. So why I trade VXX, SVXY, and ZIV and not the VXZ? Look at the daily and average volume spreads, and if options are available. And VXZ is like VXX, but a midterm basket, and options with a huge spread. That's why I don't trade VXZ, because I don't short volatility, which is extremely risky, and spreads are much too big. As I said before, shorting volatility in the VXX, it may be the 400% in half a year. So here you can see it at etfdb.com. you go to filters, you go to volatility. Here you can sort short-term volatility or mid-term volatility. I selected short-term volatility here in this example. And here you see the average volume of the VXX is pretty high, and the total assets are really the biggest asset of all volatility products. So to trade VXX is choice number one. UVXY is a product which is leveraged, but I don't take leverage products. I take the SVXY or the VXX. Because in VXX I trade options, and when I trade options I don't need any leverage, because my options are the leverage, and in SVXY I trade the underlying to have less risk. So what sort of trading systems do I use? Of course, I use trend follower. As there's an ongoing built-in drift, most of the time I use trend following systems. I use indicators like moving averages, Bollinger Bands, momentum, some sort of Donchian channel, and different contango definitions, standard deviations, VVX, which is the volatility of the volatility on S&P, which is important. I will show at the end, etc. And these are some four simple examples for trend follower. Here you see green, red, gray, and blue. Green is a momentum. Here you see the momentum. And in the momentum, which is the 12 trading days, I made a level at 140, which when the trend will switch to the upside, as you can see it here. But there's a disadvantage in the momentum trading because you switch much too late and you enter much too soon. You enter too soon, and then there's another uptrend, and then you go down. Here, the same procedure. Here, it's not. It's only one change in the trend, but you go out very late. The reason for the level of 140 is if you do the level smaller, like 130 or 125, you get a lot, really a very lot of change in trends. And every change makes the, as we say, every change in trend makes the pocket empty. So the next one is the Donchian channel, which is the highest close of the last 80 days and the lowest close of the last 10 days. And this is a very fine indicator. As you can see it here. One more thing to the green one, to the momentum. If you exit here at this time and you have a situation like here, then you give back the profit of the last 3 years. That really hurts so much. Here, in the trend definition, you get out much earlier, like here, somewhere about here, and you enter here at a good, really very good level. Then you have here the trend definition to the downside, another up, and another one to the downside. Here you go out with the downtrend, and here you enter the uptrend, and again to the downtrend. A really very good, very simple trend definition. And of course, there are some fault signals like here in 2016, when it's going up and down, up and down. But a very big advantage of this indicator is like it's not like the Bollinger Bands. Here I have different definitions. and it's really pretty close the all-time low, which is going up and up and up, and you can really enter on a good level without being stopped out by a trend change. When you really have very many changes in the trend, if you use a moving average, which is here with the moving average 100, as you can see it here, no much. It's a pretty good indicator until you get in a sideways. And here in the sideways, you see up, down, up, down, up, down, up, down, up, down, up, down, even here, here, and here. And this really costs a lot of money. A lot of your profits are gone. And when you are in this downtrend, you need a very long time to get the losses back from areas like this. And this, the last example is Bollinger Bands with 80 to 20 and standard deviation of 2. But the Bollinger Bands, the standard deviation expands to both sides. So as you can see it here, it expands to the downside and to the upside. And this means the entry of the Bollinger Bands is on a much lower level because the drift is still running, but you have to wait until the standard deviation is coming back, and then you leave some profits on the table because the entry is pretty late. Not like the Donchian channel. So my favorite is the Donchian channel. I use in most of my systems. And if I use other indicators, which I do, I have to add some more indicators or some more filters to get good results. So where are the problems in trading trend follower on VXX? It's the unexpected strong updrift which makes trading difficult. And if you compare the highest close and the lowest close, as I said before, over a certain period of trading days, you will find there will be a relationship of about 1 to 8. Means simplified, updrift is much faster than the downdrift. Another thing, trend follower do usually have a lot of small losses and less, but hopefully big winners. But here you have a built-in drift. Here you really have a built-in drift all the time over a period of more of now 15 years. Of course, with the interruption to the upside, but then the drift will work again. And why? Because the drift, again, it's built in by the calculation of the baskets. So another thing is shorting volatility is extremely risky. As I said before, VXX can go up more than 400%. And then if that happens, have a look what happens to your margin risk. And for example, IB doubled margin for all short volatility positions. That's why I cut my trades when volatility spikes above a certain level. I use for an indicator, for example, the VXX and others. And I divide the trend in smaller parts so I get less drawdown and some sort of diversification, because not all systems are trading in the same way. And very important, I only trade long positions with no margin risk. I buy puts or I buy calls or I buy the underlying, but I don't short the underlying, I don't short puts, and I don't short calls. And what is the difference in trading VXX to SVXY or TIF? Again, shorting volatility is extremely risky. That's why I trade VXX put options, long only, and in SVXY and TIF, I trade the underlying, long only. And of course, an important difference of underlying versus options. Options have different strikes and time value. So to reduce continual loss in time value, which is the so-called extrinsic value, I buy the longest available expiration of a VXX put options, which is about 6 months, and will sell it after 1 to 2 months, still with a big amount of time value, because options will lose much more extrinsic value near the expiration. The last 2 months, the extrinsic value drops like a rock. Then I re-enter if there is still a positive trend definition. And I may adjust the strike. And again, I take the longest available expiration of about 6 months. In SVXY or TIF, there's no loss in time value because I trade the underlying. And if there's no major drop caused by which will have an exit, a trade can last for years. I will show in 1 minute. This was now a VXX test. You see here 3 different lines. These are all the trades the system would have made in the VXX shorting underlying, but I will not short the VXX. But this is the equity curve of shorting an underlying, and the yellow one is buying puts at the money. Same entry, same exit at the same time. This strike is always at the money. And so you can see it here. 2 things. First of all, if I buy a put out of the money, slightly out of the money, I have better results. And as you can see it here, the drop here is much bigger than the drop here. Why? Because you lose a lot of extrinsic value near at the money. And if you are out of the money, you have less loss in extrinsic value relative to the price you paid for the put. So one very important thing is I build a system and I optimize and optimize and optimize until I get over-optimized, and when I get live, the results are not as they should be. So my way of making a trading system is I don't use many parameters. For example, I only use close end of the day data to reduce the daily noise. I only trade my system close end of the day, which means I trade the last 15 minutes or so. So this is also a good possibility for people who are working, and my signals are relevant on the last half hour of the when the markets are open. And of course, sorry, I look for plateaus of my indicators for max stability, which means results will be very close if the indicator is 1 or 2 numbers higher or lower. What means, for example, if I take in the Donchian channel the level of the last 80 days or 79 days or 78 days or 81 or 82 days, the results are pretty much the same. Another thing is I need some sort of diversification in relative to time by running 11 systems in the VXX, each one with different indicators, different parameters, and different trade durations, etc. And most of my systems are running out of sample for more than 2 years now. And this is the most important thing. When I develop a trading system, there's, as you can see it here, this is the VXX. These are the trading signals. As you can see it here, I divide the trend in many small parts, and every one of them has the same trade duration. The red one here is the equity curve. The investment looks like I make an investment of $1,000 every time I enter a trade. The blue line is for me for checking if the system is still good in shape. And this line is always $600 below the all-time high. So there was an all-time high. So this is the new all-time high. $600 lower. But again, I don't short the VXX. So the system itself optimize the data and the algorithms from all the data from 2009 to 2016. Here, this was training. The system was trained to get good results, not the best, but robust. And from here, the system doesn't know which data is coming. It's running out of sample from February 2016. And here I watched my system I developed the system end of 2017. There was an out of sample area here of 1 year. And half a year later, I started live trading on 14th of July. And this here, from this time on, I trade this system here, VXX2, live. And these are real results. Here at the bottom, you see the VXX, the TIF, and the SVXY. And if you see here a line, that means the system is deactivated. It's not valid anymore. I have here 9 systems trading the VXX, which is the system number 1, 2, 3, 4, 5, 6, 7, 8, and 9. And here's the two special systems. If there are huge volatility eruptions, I will show you at the end of the presentation. Here are 9 systems plus 2 additional systems. And these 2 additional systems will trade with triple size. That's the first portfolio, the high risk portfolio. Then I have a low risk portfolio, which is the TIF, because TIF is much less volatile. And it is made out of 3 systems, TIF 1, 2, and 3. Here you see system 1 is active, system 2 is not active at the moment. This is system 3. And same for SVXY. And here in TIF, I trade the underlying, and in SVXY, I also trade the underlying because I can go here long. But here I should go short, but I will not go short. That's why I buy puts. And puts means they boost the results in both directions, of course. When it's going to the upside, the results are boosted to the upside. And if it's going down, the loss might be higher, or the loss is higher. So why do I trade 3 portfolios on the VXX, SVXY, and TIF? Again, trading volatility is risky, or you might say is very risky. But inside the risk, there are 3 different risk levels, as I explained before. Low level is, of course, the TIF, which is the mid-term volatility basket. I only trade TIF long, 3 systems, and it's not as volatile as SVXY and VXX. Why? Because there's a lot of extrinsic value in the futures. The extrinsic value in the futures is between 4 and 7 months. That's not like in the SVXY, because here there are the front and the following month. But here I call it the moderate level. It's SVXY long, only 3 systems like the TIFF, but there is a risk of acceleration event, like you saw this huge drop from 114 to 40, 90% loss. And high level is, of course, the VXX, 11 systems, put options on VXX, which I do. But all 3 portfolios have emergency exits in case of very high volatility, not high volatility, but very high volatility. Why very high volatility? There are often, like in front of some elections or something, the volatility is high, but not going as high as like events 5th of February this year, and or the last volatility eruption like some weeks ago. And some systems may also switch to the other side. So if I am here with when I buy put options and there's a huge eruption in volatility, I may buy call options and going long VXX. Every portfolio is independent and can be traded separately. So there's no relationship between this different portfolio. In if you look at the algorithms, these are completely independent algorithms, so each portfolio can be traded separately. So let's go into detail. This is a VXX portfolio, 11 systems, the underlying. This is the this is the VXX. Going down, 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 down all the time. This is the equity curve. Most of the systems are optimized until 2016. And these are live results. Here I made three signs at the same time in all 3 portfolios, because I started the SVXY and SIF. I started live trading in June this year. So I take the same time. And what is here at the top, the green one, you see how much investment it is. So the maximum is 12,000, because every system except the volatility eruptions, which is triple size, 9 system trade with in this system trade with $1,000, and the volatility, as you can see it here, it is active, and here it is active, and here it is active, will trade triple size. But in case of, as you can see it here, there is some sideways, then you can see it here, most of the systems are not active at the moment. Here's a sideways, here you have very less systems running. Same here, for example, here it's going up. Here only the Vola system is active. Here you have a time when it's going nearly sideways, and when it's going sideways, a lot of systems don't have a trend definition and don't trade anymore. And this is the underwater equity, the most important indicator in a trading system. Programmers say, if you optimize a system and you have a underwater equity or like this, then it should be realistic to have a maximum drawdown of double or triple the size. Here, this is live. Here, there's another volatility eruption, but my drawdown is not higher than here, for example, slightly higher than here. But I don't trade the VXX short, I trade put options. And this is the portfolio. These are live trades, all closed trades, VXX put options, or some less call options. This is the portfolio options, 11 systems since July the 14th of 2017. Here you see the performance of each trade. Here there was a good way up. Here this was of course February the 5th, here to the downside, then another new all-time high. Then it was going sideways because there was the downdrift from the February this year down, had many eruptions. There was still a lot of fear in the market. So most of the options went sideways. And here there was the new eruption, and all the trades finished, some of them, most of them with a loss. But the loss is not still on a high level. The equity curve is still on the high level. This is the portfolio of the SVXY, 3 systems live since June the 1st, which you see it here. This is the one. Again, here you have the SVXY, here you have the acceleration event. This is the equity curve of the 3 systems. The system here is going short with puts. Here it's trading the underlying, here it's going short with puts, and here it's trading the underlying again. Here you see the max drawdown of the system. Here you see the investment. And this is the real drawdown at the moment, which is half the size in an optimized area. Then the last one is the TIF portfolio, 3 systems live since June the 1st of 2018. As you can see it here, trend follower, don't like sideways. As you can see it here, the investment is reduced, but in sideways, it might cause some losses. But there is a built-in drift. But built-in drift means you may wait for 2.5 years until the drift is working again. And you have new all-time highs. So this is the underlying, the TIF, as you can see it here. Here you have the drop down, no acceleration event, but a drop down of 30%. And this is the live result. This is the TIF from the June, as you see it here, the 6th of January. Sorry, the 1st of June. Of course, it's German data. And here, this is a live result from the portfolio. You see here the big drop to the downside. Here we have sideways. Why? Because systems stopped trading. So one last thing is, why did I make adjustments in June 2018? The reason is the 5th of February this year. There was an acceleration of increase in volatility like never before. In the last 10 years, the increase in the VXX changed from about 6 months to nearly 1 day to get the peak. And this also caused an increase in the VVIX. And here you see the chart. This is the VIX. You see the peaks are slightly getting lower of the unknown event. I talk about the unknown event. You see the peaks are slightly getting lower. But the peaks in the VVIX, which is the Vola on Vola, the volatility on the volatility of the S&P 500. And you see the peaks are getting higher. And this was a peak in 1 day. Lehman crisis. You had a level of this is the scale of the VIX, the VVIX here on the right side. Here you had a level of 130 to 40. Here you have 180, and it's close of the day. It's not the highest, which was above 200. It's only close data here and here. All I only trade close data end of day. All systems. So that's why I noticed, okay, the VIX is going down, but the VVIX, the acceleration is going up and up and up. Here you see here it takes some month until you get at the peak, and here you have it in 1 or maybe 2 days. So that's why I have to make a modification of my systems, and I developed 4 eruption indicators. One of them is, for example, the difference from the close to the all-time low. As you can see it here, here was the all-time low. There was a new all-time low here. And then it went up until this peak. And the new all-time low was at this time down here. And this is one indicator. You see several peaks which were all about eruptions bigger than, don't know, 10 or 15%. And you have here different signals. Here you have different signals. This one is for example, is the VVIX, which gives also some signals about a certain level. As you can see it here. And this one are some sort of relationships between the VIX and the futures or different futures. And here you see also some different signals, but only when all 4 eruption indicators, indicators have to give a signals at the same time, then you get the signals even to the upside. Here I buy long calls. I buy calls in the VXX. Here is a turning point, a definition of a turning point. Then it's going to the upside again. Sorry, to the downside, of course, until a new all-time low. Then the system will be sleeping again, as you can see it here, not active. Here's also an eruption that was flash crash. 4 signals at the same time in every indicator. But no signals like here. Here you have also 4 signals, but not at the same time. And look here, there's no big eruption. Same here. 1, 2, 3 signals. No, not a really big eruption. So the thing in developing trading system is always not to make the profits higher, but to reduce the loss. Because if you try to make the profits higher, you are on direct way to over-optimization, and the life results will be not as you think. Let's tell it like this. So this is the situation at the moment. This was February. And in June, I installed the new system. And here you see I had a long signal in VXX, which means I buy calls. And then I switched to puts again. So these are my trading systems here. Here you see this is a screenshot of my trading system at the moment. And there's a signal service, and I made a promotion for it. There's a free trial until the end of 2018. You can watch my signals until the end of 2018 for 0. Then it's 59 per month for 2 months, and then 99, and the regular price is $129. Or you can make a package of 6 months for $450. I hope you enjoyed the presentation, and now let's go to the questions, if there are any questions.
Yeah, I don't see any questions. Oh wait, Gary just put one in. How do you modify your SVXY trade algorithm for the change to SVXY after the February event?
I made pretty the same thing as in the. This is our trading system. This is live. This is the SVXY. Here you see there is some. There are some signs when I see there's something coming up, and my algorithms tells me to go out here at this level. But of course, this was optimization. The real trading started here in June. But I have to take into account what happened here and to modify my indicators, because events like this really hurt. And this is only one system. The other system tells us is only doing shorter trades in the SVXY. They always go to a new all-time to a new high, and then it's finished. And this system even is like this system here. Here you see these are the very high volatility eruptions. And here it's going long, here it's a turning point. And at this turning point, it switches to the other system here and is going to the downside until the new all-time low from here is hit. Same here, same here. Here there were 1, 2, 3, 4, 5 signals, and this was out of sample signal. This was real signal here. And then it switches to the downside, like here, like here, like here, like here. Of course, you don't have successful trades all the time. It's only 60%. But altogether, it's pretty nice, because you have to add these two systems. And here we are not at the all-time low. The all-time low will be on this level, and then this result will be something here in this area. So what I do is, as you can see it here, it's pretty the same. When this system is going long, the SVXY in this system is going short. The other are already out at this time. So that's what I do. Pretty the same in SVXY as in VXX. And some of the indicators are identical. For example, the VXX. And the VXX is really a very good indicator. If it jumps about a certain level, then all lights are red and go out, go out, go out, or quit the trade or switch to the other side. So next question.
That's it for the questions. I'll get based on the plan that you have for payments, I'll get something set up and send an email out to everybody that this is available. So I'll have that probably today.
Okay, I would like to talk about the eruption indicators. For example, here you see it here more in detail. This is going long, then going to short. Here you see the difference. Here was the all-time low. And this is the difference from here to here, the maximum, the close to the all-time low, the difference. In percentage, of course, because here you are at 10,000 and here you are at 36. So of course in percentage. And here are some exit, some alert levels, but only all 4 at the same moment. And as you can see it here, they are not all at the same moment. This one was too late, so there was no signals, and that was okay, because it is very often that there is a small volatility eruption and then it's gone the next day, one day after that. And that happens a lot. It's like here, like here, like here, like here, 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 here was a double top, and so on. And to eliminate such trades is much more important than try to making bigger profits with the winners. And one thing is, here I have a nice example for that. This is the system VXX1. The green one are the emergency exits when the VVX entered a certain level. You see here, there are a lot of exits. Here you see exit. It didn't close after the regular time with trade duration, but it has an exit by the VXX. And these were 99 trades. Profitable trades about 63%. Then I made some modifications due to this event here in February. And this is the new system. You see the profitable trades change from 33 to 63 to 72%. But much more important is there were 99 trades. That's the average return of 55. And here you have you have 22 trades less, but a much bigger return. Here you see the profit 5.5, and with less trades, a bigger profit. So these are only, I replaced only 2 systems since the beginning. This is a system number VXX1 and system number VXX8. As you can see it here, the line means deactivated. And this is a new system, which is a mixture of standard deviation and a cross, for example, with the future 1 and future 3. When they cross a certain level, then there will be a signal. And I mixed these 2 systems into one system, and that's the new system VXX number 8. Well, it looks pretty good because the maximum drawdown of the equity curve is pretty low. So as long as the system of the underlying is working well, then the put options will also work well. Because if the system doesn't work, then put options, of course, also doesn't work. And one last thing. This is a chart. When there's an up day, I add +1, and if it's a down day, I subtract 1. And here you can see this is from the beginning 2004 until today, and this is the number of all the days if there are more up days or down days. And you see the down days are much more than the update days. And if you take this one and put it down here, you see pretty the same result. And one more thing here is the difference. How huge is the drift to the upside in one day And this is how big is the drift to the downside, the difference from one day to another if there's a down day. And as you can see it here, this was the 5th of February, the biggest up spike ever in one day. But if you look at the average, here I made a moving average of 200 days. You see the average of all days are 0.016 drift to the upside and 0.0157 to the downside, which is pretty the same. But you have much more down days, which is 583 at the moment, more down days than up days. So this causes the drift to the downside. I think that's explanation enough why I trust my system that there will be a downdrift all the day, all the time.
So Igi, can you maybe explain to people who aren't familiar how you send your signals out? Is it they're good like near the end of the day, or how do you run the system if somebody were to subscribe, for instance?
Okay, to not confuse the people, it's going like this. Wait a moment. Here I have, these are in total 16 systems. No, 17 systems, sorry. 3 systems on on SIF, 3 systems on SVXY, and 11 systems on VXX. Every day in the morning, I send a signal if I expect a signal. I send a SMS if I expect a signal. And if I expect a signal, I will go more in details, sometimes at the beginning of the day or at the beginning of the market. And of course, in any case, you will get precise info what I will do. For example, in SIF, it's pretty easy. You see it here, these are only 4 trades in what is it, in seven years. So some trades may last for years, and some trades will only last for 1 or 2 days. But every day I send a SMS if I expect a signal, if there is a level who has to be crossed, which has to be crossed or not. For example, here you see I will tell if I am at the end of day below this level, I will go out, and here I did. Here I know this level, and if I am below this level, I will tell everybody with a SMS, this is the level when I'm below at the close end of day, I will go out. And then about 15 minutes before market closes, I will exit the trade here. And this I will do for every system. You see sometimes there are more signals, sometimes there are not so many signals. Here, for example, you don't see very many signals. These are only about, let's have a look, 11 trades in 10 years. And here with the VIX, with the VXX, I have to say which strike I will use, which expiration. Expiration is normally always the longest possible expiration, which is at the moment it's March next year. This is the longest available put option in VXX, and I will use them. So I will tell if there is a signal. For example, 2 days ago, there was an entry signal. I told everybody there might be a signals because I don't have a crystal ball. I can only tell there might be a signal. And if there is a signal, I will send an SMS about 1 hour before market closes that there will be probably a signal. If there is an entry level which has to be crossed, I will tell the level. And of course, I will tell the expiration and I will tell the strike. I think this is explanation.
Yep. And then Gary asked, will you be switching from VXX to VXXB soon?
At the moment, I only use VXXB because there are VXX put options until March. There are no one. There are only some, and you can't buy new VXX options at the moment for March, for example, or for January. They are closed. You can only cut them. You can only sell your close your open positions, but you can't open another one. And at the moment, all my trades is on the VXXB at the moment, and there will be only VXXB trades in the future.
Sounds good. Okay, he says thanks. Well, I think that's it. We're a little over an hour, so it's probably a good time to stop. No more questions. So thank you, Iggy, for coming on and explaining the triple tool trade.
Okay, thank you, Tom, for having the possibility to show my system. I think at the moment it's one small last thing.
Sure.
Here in my chart, let's do full screen. This one. Here you see, these are the all-time lows. And after a certain time, you always have new all-time lows. Here, of course, this was Lehman crisis. There was a big fear in the market. This lasted for 1, 2, 3 years until the new all-time low, which was faster than new all-time high in the S&P, by the way. And here, the longer you have to wait for a new all-time high, new all-time low, the higher the possibility of reaching a new all-time low. And here I think it's a pretty good time to enter trade, and my system start slowly adding systems to the downdrift. And I'm still very confident that my system will work, because when here I'm in an uptrend, I go out here. I don't run dead horses and hope that the trade will come back, because you will not win, because this time is much too long. This is much too long, and you will lose a lot of time value. I go out with a small loss in about which is about 30 to 40%, but it's options. That's not really a big risk. It's not a total loss. And the system will enter here, and the first system already started to enter here at this high level. And when I get here a new all-time low, that will be nice. And as you see it here, after such long time, no all-time low, there was always a nice drift to the downside. Here it was 2 years. Here it was more than 2 years. Here it was 1 year. And in times like this, you can really make big profits. That's my hope.
Yeah, we all like the profits.
Yeah, sure. But it's not only liking the profit; it's going out at the right time, not too late.
And we like the small losses too.
Yeah, and don't ride dead horses.
Yeah, exactly.
Because extrinsic value is running against you dramatically the last 2 months. You will not win. You can't win.
Yep. Okay, well, let's wrap it up. And thanks everyone for coming. And I'll get this posted as soon as I can, and I'll send everyone an email with the links to sign up with these special prices that you've got.
Okay, thank you, Tom.
All right, thanks everyone. We'll see you
Yeah.
next time. All right,
Okay,
bye.
ciao.